Welcome to Business Talk here on Business Tech, South Africa's #1 business news website. Now, even for the wealthiest, I think the coronavirus crisis challenged the notion that money could buy anything. Sure, if you're super wealthy, you could probably charge for a plane to take you to a private home in a secluded location. But you wouldn't be able to go out and get a meal at your favorite restaurant. You couldn't even go and buy your favorite drink at one stage. And I think as jobs were slashed, emergency funds became ever more important. But how many people had liquid cash at the time or had to cash out at the market bottom around March and April of 2020 just to deal with the crisis? So I think there were some hard lessons learned, and to discuss these lasting impacts, some of the scars on the way we view our wealth and finances, it's a great pleasure to welcome Adriaan Pask, who is Chief Investment Officer at PSG Wealth. Adriaan, I've got to say, you did call it before the COVID crisis. We had this conversation about rising inflation and rising rates, and it's all come true. So always a great pleasure chatting to you. Talk to me about the way this national lockdown transformed the financial outlook for all South Africans. What do you see as the biggest changes to customer attitudes that you've experienced at PSG?
Hello, Michael. Thank you very much for having me. And it's always good to catch up with you, and a warm welcome from my side to the listeners as well. Yeah, I can speak to our business, and I think where we were fortunate is that our business is really a people business. So we stay very close to our clients, and the one-on-one guidance that we provide obviously helps quite a lot in a challenging environment. So you don't really want your clients to alter the approach to the investment portfolio during a period like that. So obviously we engage with our clients up front to explain what the plan is to get them from point A to B, whatever their goals might be, and not really to deviate when the challenges hit. These challenges are always present, and if you embark on a long-term investment journey, there's always going to be something that threatens to curtail your approach to your investment strategy. So I think it helps to prepare clients up front so that they understand that those things are perfectly normal as you embark on that long-term investment journey. So from an investment perspective, very little has really changed in our environment. Like I said, our approach has been to focus on the long term, and our clients understand that process, which has served them very well over various preceding challenges. So I think the trust that we've built with our clients has been key, and obviously we continue to work on that. We've benefited, to a certain extent, so the practicalities of engaging with clients and to do business, meant that we had to adapt. So, I mean, if an important part of what we do is looking a client in the eye and walking them through something or off the ledge to an extent, then obviously that becomes a bit of a challenge in an environment where there's a lockdown, for example. But our clients have managed to adapt really well. And after COVID, we've actually managed to find the best of both worlds. So we do a lot of client events, for example, just as a method for keeping engaging with clients, telling them what we think, creating some clarity around the challenges, calming nerves. And through COVID, we have obviously had to embrace technology as part of that. But now that has passed, we do a lot of hybrid events where we learned through COVID that there's ways and means of engaging clients in outskirt areas, for example, which we couldn't do before. But obviously, we still have a need to look clients in the eye. So with a hybrid event, you really get the best of both worlds. And then obviously, I mean, if we look at the behavior of South Africans, there's quite a few of our clients that obviously also went through the semigration approach, and that client mobility is a big thing. We see it in labour mobility as well, and we've adjusted our process accordingly. So I mean, it's efficient and productive for our staff to also spend time working from home, for example, or for clients to phone in from remote areas, and they're comfortable with that approach. I think we forget that, especially older clients were quite averse to that kind of thing previously. But, obviously they've opened their minds a little bit, not by choice really through COVID. And people have embraced that type of style of doing business. So I think we've been luckier than most businesses out there. I mean, there's not many businesses that can pivot and adapt to approach clients in that way. So I think we've been very fortunate to navigate that period quite well.
Yeah, and I think to your immigration point, it speaks to the fact that financial advice is such a relationship game. It's such a personal business. And often you'll have a financial advisor who will advise you from your early 20s, hopefully, and you're making good financial choices and putting away for retirement from a young age, but will follow them all the way through until retirement. So that individual, and you say it's trust. It really is about trust, but that is built up over time. And often when you move, you kind of want to take your financial advisor with you. But I think being able to advise remotely now offers people the ability to do that. When you look at our the way we manage our money, I think South Africans, it's fair to say, have historically been quite poor with managing money, with our personal finances. We like to keep up with the Joneses and get the latest house and car. Are we getting better at this? Are we still struggling to invest and save our money effectively?
Yeah, so our savings rates don't look great, and it's been the case for quite some time. I think the unfortunate reality is, when you speak to people and say and explain how important it is to keep investing and think about your future and what your lifestyle is going to be like in retirement and whether you've saved enough, there's still a large component of our population that is just simply not wealthy enough to save. There's still a large portion of our population that lives from paycheck to paycheck, and even at the same time raking up a lot of debt at the same time. But I think our core message is that what we see out there is too little saving, and it's often when people do engage in the savings journey, it's done too late. Or they're not aware of what the liability is. So when I say liability is, well, what is your liability in retirement? How much money do you need to have? So that's essentially a debt of sorts that you need to make a provision for which you need to have sufficient funds to sustain yourself in retirement. And without knowing what that number is, it's very difficult to understand whether you're saving too much and too little. And if we look at the savings rates, they have steadily declined. And debt levels have steadily increased. And this has been the case, even from the 60s onwards. We used to experience quite high household savings rates, even in the 20s at times. And what we've seen even through the 90s and early 2000s, that moved well down 10%, in the early 2000s under 5%. And now with COVID, we've even seen those turn negative during periods because people are actually digging into their savings to sustain themselves. So that has now luckily rebounded and it's positive again. But generally the story is quite bleak. And I think it comes back to affordability to one component, but also a little bit of naivety around, what is required, how much time is left, etc. But unfortunately, to answer your question more directly, savings rates have remained fairly depressed, and unfortunately, debt levels have increased, as I've mentioned. So, unfortunately, not really progress in that regard for the average South African.
Well, and I take your point, Adriaan, about South Africans potentially not having enough to save at the end of every month. But I was visiting a complex the other day where a friend was staying, sectional title units, and not in the most glamorous area. But if you looked at the cars in the driveway, you would have thought that driving past an individual on the highway, they were driving back to a 5-bedroom mansion in Ilovo. So there's a disconnect here. And again, we do try and keep up with the Joneses, but you forget that at one point in life, you're going to have to retire and your savings are going to have to see you through. And the sad thing is, there's the rule of 72 in saving, but I think it's been turned on its head. Now people are saying, well, just plan to die by 72, so you don't have to worry about saving. It's kind of a throwaway line, but we're living longer and we're saving less. It's not a good combination. Why do you see, where is this disconnect coming from? Because clearly it's vitally important to have a substantial retirement portfolio.
Yeah, so I think some of it comes down to a little bit of financial literacy. So just understanding how expensive retirement will be, and how important it is to make sufficient plans. So you've mentioned just the longevity component. So people are living a lot longer, and at the same time we see people retiring sooner on aggregate. So those two stats are a little bit at odds with one another. What we should be seeing is a lot more saving. People probably need to work for longer because they're going to live for longer. They need to save more aggressively, and I don't mean in the sense of a risk profile of sorts, just by way of contributions. You're going to have to take those factors into account. But I think that's where financial planning is incredibly useful. So, I mean, you can see exactly what is required of you if you go through that financial plan, to ensure that you can adjust your plans for, oh, I thought I might actually pass only at 75, but it looks, according to the new mortality stats, that, a person with my lifestyle could very easily live to 90 or even 100. And those things are very, very plausible, but people aren't aware of these factors that they need to take into account.
And a part of that, I mean, you mentioned your risk profile in terms of your asset allocation, but I think part of that has obviously got to be to sit down and realize that over time, equities are where you want to be. But I think many South Africans still see owning and trading shares as too risky. Talk to me about how we should be considering our approach to equities, given what we've seen in the market this year. It must be a difficult conversation to have because in dollar terms, I think all markets are underwater this year. And so difficult to try and get people to stay the course in equities in an environment like that.
Yeah, absolutely. I think, that's why, to my earlier point around preparing clients up front, the right time to have that discussion is actually not when things are difficult and clients want to disinvest from equities and they're averse to using it. The right thing to do is to actually have that conversation when we are in a more neutral space where you can have a conversation with the client to say, you know what, this is a long journey and there's going to be many challenges on the way. We don't know what they are. But if you look at history, there's COVIDs that happen, there's global financial crises that happen, there's oil crises, there's inflation crises, there's always something happening in the world. And you can't always just sit on the sideline and wait for a more comfortable time to invest. What we can rather do is sit and devise a plan, make sure we take into account those kind of factors so that when they come, the conversation is more to say, we expected this, your plan is already catering for something like this. There is financial pressure on your portfolio at the moment, but history shows this too shall pass, and it's important just to stay on track. So that's a really important component in it. And when it comes to equity investing itself, it's really one of the few asset classes that can drive growth into your portfolio. So cash is not really going to preserve your purchasing power, for example. So you need to embrace that at least to an extent into your portfolio. But that being said, I think it's really important to make a distinction, first and foremost, between trading and investing, and also what is the most suitable way of getting there. So, for people embarking on an investment journey, stock trading wouldn't be my logical departure point. If you're going to start investing, I would say rather look at forming a good foundation underneath you where you invest first. So, use something maybe a little bit less adventurous. Look at a unit trust, for example, that can still give you equity exposure. But a lot of that, trading and investing is done by a professional money manager that is focused on that and is trained on that component. Yeah. And if you just think logically about this, it's strange to me how there are still clients that, they want to save and the first thing they do is open a stockbroking account to trade stocks. So I think there's a space for that, absolutely. But typically you need that foundation in place first to say, I'm going to invest. This is not nearly as exciting as what it normally seems to clients. So I speak to clients quite often or potential clients out there. And it's amazing how people perceive investments to always be this exciting, almost, share trading type mindset. But in practice, it should be relatively boring. You should have a plan. You should put the money away. You shouldn't watch it daily. It shouldn't factor as your entertainment in your day-to-day life, So that's an interesting component. But like I say, it's incredibly affordable at this point in time as well. It's not like the olden days where we're using financial planners or investing in unit trust requires either large minimum amounts of investing or it was expensive. it's very easy. You can now save, there is even places that allow you to save 200 Rand a month on a debit order, and the charges are 1%. So, I mean, you're essentially paying 2 Rand a month to get your investment in there. So it is a lot more accessible. But I think the missing link is awareness around what is the most suitable way of getting that done.
And it's just a fact of life. I think people don't roll out of bed and say, oh, right, I'm going to go and do my financial plan. I'm going to go and invest in the stock market. It's more something that's sold at the end of the day. And again, why I think the role of financial advisors is so important, and why I really was worried when we started to see some of the regulatory RDR type changes made, because, while I'm obviously mindful that there were some charlatans out there, I think the bulk of the financial planners I've ever met in the last 2 decades really have been ethical, professional people. It's about providing that bridge. And without that bridge, people just don't save. It's why our retirement stats are so poor. The Alex Forbes numbers are what? 6% will eventually retire with what is enough, whatever that magic number is. 6% of South Africans. That means 94% of us are not getting enough at the end of the day. As PSG, you're one of the largest financial services groups in South Africa, and you've got a lot of data at your disposal. What are the key trends that you're seeing as we move into this post-pandemic world, Adriaan?
Well, I think maybe just to bolster onto your previous point, when it comes to these numbers in terms of who has a sufficient amount, saved away for retirement, it's not a crisis unique to South Africa at all. If we look at savings rates globally, they're low. But if we look at gross replacement rate, so that's typically the actuary's ratio for how much of your existing income will you be able to replace in retirement. So, for example, the rule of thumb is for every 100 Rand that you currently have, you'll at least need 70 of those rands in retirement. Then you're okay from a savings perspective. But if you look at the stats all around the globe, even in developed markets, it's way under what it should be. And globally, we're actually in a fairly significant retirement shortfall crisis. There's talk of even the social system that focuses on social security payments in the US under significant pressure. It's not going to last forever. There's just too little savings going in, and the load in terms of people who need money out of that is just increasing significantly. Even savings rates in the UK are way below what they should be. So globally, people are not saving enough. And it speaks a little bit to my previous point around, I think there is a little bit of ignorance around financial planning, just basic financial planning. What is it that I need to be able to put away in order to sustain myself in retirement? But more in the present, in terms of what we see from data, especially in South Africa, is that sentiment is incredibly negative, and this applies to consumers, as we all know, as consumers out there. But business confidence is also incredibly low, and a bigger concern, because this is a key driver for investment performance, is that foreign investment is also quite low. So we see industry flows into unit trusts, into equities have started to taper back. Businesses are concerned with increasing funding costs as interest rates rise. Foreign investment has been under pressure as flows are heading outside and not into the borders of the country. And that also speaks to the fact that offshore investment is the one area that seems still in very high demand. A lot of investment taking place in other areas, and unfortunately, I think what's at play there is still there's a lot of performance chasing. So until very recently, offshore investments did fantastically well. So it's quite logical for clients to look at that and say, South Africa's been a tough place to invest in, and offshore things are going so well, and we've got Eskom locally, and offshore things are wonderful. But the reality is that that's not really the case, and I think people often underestimate the risks associated with investing offshore, especially at the moment. And we can see, some glimpses of this taking place in markets as we speak. Yeah. And unfortunately, I think in South Africa, the appetite for South African investments and South African equity in particular is incredibly low. But I would urge investors to remember that normally the risks accrue in the areas that are crowded, and normally the opportunities are weighting in the areas that are less comfortable and less obvious. The less crowded areas of the markets are normally where the opportunities sit. But if we say that, that was created by the negative sentiment that I've mentioned, and it's going to be very difficult to convince someone to invest in these areas and avoid the more logical ones. But that is part of the job as an investment manager, and that's exactly why you need to make use of the services of professional money managers out there that have seen that understand those dynamics in markets.
Yeah, because when that sentiment does change, the re-rating can happen almost overnight. It can be swift, and then you sit there thinking, boy, I missed one of the golden opportunities of a generation. Just in conclusion, what advice do you have for anyone who either wants to begin their investment journey, they're maybe in their 20s or even 30s or 40s and they're starting a bit late, or wants to just maybe improve upon their existing basic investment strategy? What would your core kernel of advice be?
Well, I think a recurring theme through our conversation now has been that people often don't know just where to start, or they don't understand, some of the more fundamental principles, and that's perfectly fine. I mean, that's a job on its own. You can't expect people who have other means or other jobs to know all the intricacies of markets. But I think if you're considering this and you've been putting this on the back burner for a while, I would say go to our website, get the contact details of the nearest PSG office, contact them, and just have a discussion. Just have a discussion on where you are financially, what is it that you intend on doing, and then hear what the services are in the office, how they can help you, what does it cost. All those things can be discussed, and get comfortable with that, at least so that you know what the options are. I still think there's way too many people that just completely steer clear of it because they're intimidated by the whole process. And you need to be intimidated by the process. And secondly, I think that the other theme that sort of popped up throughout the debate has been the concept of doing your own research. And the way I see it as, it's very good to do your own research. I will always encourage investors to do that. But I see that as a supplement for your plan, not a substitute for the use of professional money managers or financial planners. Those people are intricate in making sure that you're successful at the end of the day, and your own research can supplement that. But in my view, it's not a substitute for it. It's just too complex, and you need a professional out there to make sure that you're doing the right things. You can't take chances with your finances. Most people don't have money to waste or do the wrong things or make mistakes. So it helps to have that helping hand by your side.
It just always amazes me that we're willing to take money out of the wallet to spend on healthcare, medical aid, but when it comes to financial wellness, which is equal to, if not more important at the end of the day, when you consider what we were just talking about living longer, then we kind of, we're more hesitant. And I think those last points were very important. Sit down, have a coffee with someone at a local PSG office because they can help. Adriaan, lots for us to consider and lessons that hopefully a few of us have learned through the pandemic. Take care.
Thank you very much, Michael. It's been great to catch up.
That was Adriaan Pask, Chief Investment Officer at PSG Wealth, here on Business Talk.